Hey, this is Danielle. Welcome to the Simpler Options free video for the night of November 2nd, 2018. So it's been kind of a crazy week in the markets. Of course, the last week we had the correction, and this week we had a rally higher that honestly at the end of the week didn't end up too much higher from where we started. So yes, we've had a nice 3-ish day rally. But at the end of the day, it hasn't really done a whole lot to correct the downside trend. So, I mean, I do still think that overall we are in a downtrend on the daily charts of the NASDAQ futures, S&P futures, Dow, and of course the Russell. So, what do we do? Well, I'm going to answer that question because if for any of you guys who know me, who have taken any of my 5-star classes, everyone has asked me throughout the course of those classes, which by the way, if you're not familiar with them, they were focused on aggressively trading the upside of the market and sticking with the strongest stocks and the strongest sectors. Now, at this point, what do we do with that, right? We have a lot of names that were on my 5-star list, like Microsoft, like Amazon, like Apple, like Google, that are no longer on this upside list. So what I've done is I've done a little bit of adjusting, and we're going to look at the downside of the market in the weaker sectors. So, of course, what is the flip side of the strongest sectors and the strongest tickers? That's going to be the weaker sectors and the weaker tickers. Okay, so where does that lead us? Well, I have two for you this week in the free video, and that's going to be Google and Alibaba. So why Google? Why Alibaba? Well, Google in particular is now within the communication sector of XLC. So if you take a look at the chart of XLC, it's very weak, doesn't look good. You have stuff like Facebook in there that is just continuing a downtrend. So I like Google for that reason to the downside, and we also have a setup on it. Second one is going to be Alibaba. So the Chinese internet names have not been doing well really since the beginning of June. So at this point, as we are now in November, I would say that it's absolutely a certified downtrend, and we can look to short the rallies. So let's go ahead and take a look at the chart segment, and I'll show you what my entry and exit points are.
All right, so let's go ahead and look at the charts. So what you can see here is something that has had a switch in overall trend. So I mean, I know Google going back, I mean, it hasn't been the best trending stock, but it was still in an uptrend, especially since the March correction. I mean, this was pretty messy in here. But we do want to respect the trend that was generally after chop. And you can see that after the chop ended, we went back into an uptrend. But at this point, this is not an uptrend. You have a complete shift and a switch in pattern. You can really tell by looking at the moving averages. So you want to look for a couple things. You want to look for how the moving averages are laid out. So right here, they're really nice and stacked. But here they crisscross and they get sloppy. You also want to look for the grab candles. You can see that the green means go buy to the buy side. And then you get a blue, which is, I say, the warning sign. So that's a warning sign that the switch is coming. So at this point, we got a switch. We traded below the moving averages. And now we're in a situation where our moving averages are resistance, okay? They're not support anymore. Before they were support, but at this point the shift happens and they become resistance. So you can see that Google came up here, it tried to break through and it could not. It just ran out of steam. I mean, after this new high, it was basically a kiss of death, right? New high, tries to make a higher high, can't do it. Tries to make a higher high, can't do it. Boom. Okay, at this point, we're in a downward trending pattern. So now we have to respect the downtrend. And what does that mean for the squeeze? Well, the squeeze is a trend continuation indicator. So if we're in a downtrend and we get a squeeze, which direction do we want to play that? Well, we want to play it to the downside. Now, keep in mind, in this overall market condition, the rallies can be pretty violent to the upside. So we're looking at shorter time frames. Of course, we already only have a 195-minute squeeze to work with. But, you can look at being in the trade just a couple days, really. And what you're looking for is you're going to try to get into that when you see a ready and fire sell signal. Boom, down she goes, and you want to target about 976. Now, like I said, in this volatile market, we might not get that full target, but if you can do something like selling a call credit spread, then you may be able to make some quick profits on that. Switching over to Alibaba, this is another one that has been in a downtrend since really June, so a little bit earlier than Google, but at this point we can absolutely say that this is a downtrend. So what do you do in a downtrend? You short the rallies. So if you look at this right here, you can see that we're starting to build up a daily squeeze. So I don't like it just yet. I mean, I think maybe we can get another 2 days of consolidation. We might not, but we have to watch for the trigger. That's why we wait for the trigger. So you want to watch for a ready, aim, fire, sell signal, or you can use a moving average cross to the downside. But regardless, your stop and your upside here, your stop to the upside is going to be 154.72. You could use it all the way up at 156 with a 50 period simple. But then your target to the downside is going to be between 123 and 115. So if we could look out for those to the downside, that would be ideal. And then where are you wrong? You're wrong if you break through this level. That's where you're wrong. You're wrong if you get a switch in trend like that. That was a failed switch in trend, came up, but this was a switch right there. So those are really the parameters on the trade. I think the easiest way to do it is just with a call credit spread. You could just buy the puts and you would be able to make more money than if you did it on the calls. But in this volatile market condition, the spreads are going to be a lot easier to sit through. You're going to have more defined risk and just overall, I think easier to trade in this type of market environment.
All right, traders, thank you very much for joining me in this free video. I also wanted to tell our members thank you so much for putting up with us when we were all traveling and putting on the live event in San Francisco this week. I will be back to my regularly scheduled trading room programming next week. And also, for those of you who are coming to us from YouTube or otherwise who aren't members with us, I wanted to take a minute to point out that we do have a new membership called Simpler Foundation, in which you can get several videos just like this from me each week. So if you're not quite ready to join the trading room, but yet you want to learn more about trading, get a couple different setups that you can join in on, make sure you go to www.simplertrading.com/join and check out Foundation. So hope to see you there, and I'll see you in the next video.